Welcome to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts, and I'm joined by Paul Strome, Dan Innes, and Nicole Dines. Nicole, what's your pick of the stories this week?
I had a look at the annual report that the Land Registry produced at the end of last week. It's an organisation that is involved in every property transaction in England and Wales, and usually the annual reports are pretty standard things. But obviously this is particularly interesting because it sets out the response to the pandemic and how they've adapted and transformed their work to progress, as they say, towards a digital future. So they introduced things like electronic signatures and digital ID checking to enable totally paperless online transactions, and launched something called the digital registration service, which with automated error checking, so that again over 90% of transactions could proceed without any hitches. As well as all the people working online, they recruited over 500 people, including many lawyers, during the time, and launched the Land Registration Academy to recruit even more people, so a national centre of excellence to support technical training. So that seems to be a really sort of good news story of people recruiting, adapting to the pandemic, and also using technology in the property world. And elsewhere, I've been following the developments in Milan as usual. There was an update from the Porta Romana team, which is the place where the Olympic Village for the Winter Olympics of 2026 is going to be. They announced a revised master plan following comments from the public and also from the municipality, because it's a very complex project, a huge project that is a partnership between Coima, the Italian company, Covivio, another Italian company, but also the municipality of Milan, the Prada Foundation, which is nearby, the Olympic Committee, as I say, and the Lombardy region, which is the financial guarantor. So a lot of stakeholders all having a say. So this is the definitive master plan, which has a park at the center, the Olympic Village, with the first part to be built of the complex. It was a very competitive process, and it was awarded to the US studio Skidmore, Owings and Merrill, known as SOM. It's a 60,000 square meters area will host the Olympic Village, which has to be ready by summer 2025. So timing is pretty tight. And soon after the 2-week Olympics, it will be turned seamlessly and very quickly into student housing with over 1,000 beds. And so it was Manfredi Catella, the CEO of Coima, which is leading the project, said it will be one project with two functions and a focus on legacy, and creating a lively sort of green, sustainable neighborhood open to everyone. And at the same time as this announcement was made, LVMH, the luxury group that controls Louis Vuitton, Christian Dior, and other big names in luxury, has announced that it's taking a 10-year lease on a new Milan headquarters, which is very close. It's between the Porta Romana complex and the Prada Foundation. Covivio said that the office space has evolved during the pandemic, and the office building they've just rented out shows what it can be: very flexible, healthy, safe, and a happy space for people to live in. So the message was the office is not dead, it just has to evolve and adapt to what customers want.
It's been really interesting to watch the number of projects coming through in Italy, that focus on ESG and the student housing side. And I had an interview with Rainer Nonnengasser of International Campus, and they're increasing their target to 25,000 beds by 2025. So interesting to see that sector continuing to grow. Dan, what have you been watching?
This week, all eyes really, especially within retail, are on today's Freedom Day, where, of course, Boris Johnson's removed most of the COVID restrictions surrounding the way we go about our daily lives. But research from CGA and Alex Partners into the hospitality sector, they suggest that there's still another 12,000 hospitality venues that could still finally open today. You know, a lot of the UK's leading retailers, they're still urging customers to wear face coverings, despite a lot of uncertainty coming from the government. The Centre for Cities, they've reported that the recovery in footfall in a number of UK cities is faltering. You know, the removal of those restrictions today, you know, that's hopefully going to sustain a bit of the high streets recovery. Elsewhere, you know, we've been following the retail and luxury sector, and, you know, revenues at Burberry were up 88% to £479 million in the 13 weeks to the 26th of June. And that's despite over 10% of its stores still closed closed due to COVID. And they're saying that sales are now in line with pre-COVID trading. Business in Europe and much of Asia is still heavily impacted by that significant decline in tourist traffic. But luxury retail still tends to be a bit of a bellwether for the recovery within retail. Elsewhere, staying in the UK, last week, several of the UK's retail landlords, including British Land and Hammerson, they ended their promise of rent concessions. That's at a time when BL reported sales across its centres returning to close to pre-pandemic levels. The FTSE 100 landlord, BL, they've allowed tenants to switch to monthly payments, and they've waived or written off millions of pounds of rent during the pandemic. But with the vast majority of its centres beginning to start trading well, Simon Carter, the chief exec, said that with these lockdown restrictions lifting, we've seen a notable improvement in activity across our markets, and the businesses performing well. Similar story at Hammerson. In a statement to investors, Hammerson said, we expect all rent collections to continue to improve as remaining COVID-related restrictions are lifted, and footfall trends in all territories remain encouraging. Many retailers continue to report high sales and conversion rates as visitors shop with purpose. So that's good positive news coming out from Hammerson there. And lastly, I've been following that story with Boston Properties, BXP, with CPP Investments and Singapore's GIC, who've established a co-investment program for future acquisitions of office properties in the US. So three big players putting together around $1 billion of equity to the program. Peter Ballon, MD at CPP, he said that he believed that the employers in top global cities continue to seek best-in-class office environments that will attract and retain talent. And by expanding CPP's relationships with Boston and GIC, he thinks that they'll be strongly positioned to serve that ongoing market need.
I had an interesting interview with Justin Curlew of AXA Investment Management, looking at both that outlook for office, but also the key part that will be played in terms of the vaccines and the speed of market recovery as it opens. And he also mentioned an increased focus from investors and capital on the alternative sectors. Paul, what have you been watching?
Well, there's been quite a lot of activity at the alternative end of the property spectrum. We've been hearing a lot about life science property lately, and Colliers has produced a report on the subject. Interest in the sector was strong before COVID, and they reckon $81.5 billion was invested across EMEA since 2010. Job creation has been consistently above 5% year on year. Colliers said this points to a need for property owners and developers to consider the readiness of their assets to support the sector. The rush of investment last year has not yet translated into an expanded life science footprint in Europe. So there's a mismatch between financial and physical expansion, and that reflects a limited supply of the right type of specialized multifunctional buildings. Supply is expected to catch up with demand as investment managers diversify into life sciences real estate, and Colliers expects investment volumes to rise from the 1% annual average of the last cycle to closer to 5% in the new investment cycle. Then there's been some activity in terms of investing in alternative construction and very much getting to the heart of the environmental aspects of ESG. Cromwell Property Group and sustainable real asset manager Dassos Capital have formed a partnership to establish a wooden building property fund. The fund is open-ended and will target an initial first close of 100 million equity by the end of 2021, eventually hoping to grow to 1 billion. Dassos CEO Ollie Haltier said that they estimate that there's been 8% annual growth of demand for wooden building projects in Europe since 2015. Unsurprisingly, the Nordics is leading the way, but France is planning legislation to ensure that all new public buildings are constructed with a minimum of 50% wood or other sustainable materials by 2022. And lastly, we've been talking about infrastructure a lot lately, and broker Knight Frank has been appointed to sell 2 UK power stations for a combined £95 million. The power stations are of the combined cycle gas turbine type and provide a secure inflation-linked income. Both are leased to a firm called VPI Power Limited and also have potential for alternative energy and distribution uses, Knight Frank says. Although they are gas powered, not one of the environmentally friendly energy sources like wind or solar, Knight Frank said they are very efficient in combined gas and steam turbines, and they support the UK's transition to greater reliance on renewable energy. Knight Frank also points out that the UK's net zero target will require quadrupling of renewable generation and doubling of the annual investment in the power sector, in addition to large investment in heat networks, waste management and electric vehicle charging points. So infrastructure is very much a growth sector.
In terms of the alternatives, I noticed South Korea's Public Officials Benefit Association fund also gave 200 million as a third tranche of equity to CBRE Global Investors to build a diversified European real estate portfolio, and again expanding the remit of that to look at areas such as healthcare, data centres and those alternative sectors. And on the ESG side, Collier's announced a global link up with Measurable to help clients achieve meaningful progress towards ESG targets. And with COP26 rapidly approaching and the extreme weather incidents experienced across the globe this week, that drive looks set to only gain in strength. Thank you, Paul. Thank you, Nicole. Thank you, Dan. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the key themes in real assets.